Hi, this is Peter Zlamaya and welcome to No Option Antics, and here we'll be discussing put options. And let's explain what a put is. A put option gives you the right to sell something at a set price by a set time. So let me give you an example of a put option to make it more clear for you. Think of this as like insurance policies. Okay, if you have a home, generally you're going to have an insurance policy on your home. Think of the put option as the insurance policy for your home. So most people would consider their house an asset, but never do people consider their insurance policy as an asset. So let's suppose that you own a home that's valued at $100,000, and we're going to call that asset number one. Let's say you have an insurance policy to protect your house. We're going to call that asset number two. Now, the insurance policy is there to protect your home, and so is the put option to protect stock. If your house were to burn down, what would happen is that asset there would be worthless. You would have zero value in that asset because it would be a big pile of ashes. But what would happen is the insurance policy would gain value to cover the losses in the home. It's an offsetting asset. Now, puts are insurance policies, and just as you have an insurance policy to protect all different types of things in your life, puts can protect your stocks, they can protect indexes or indices. They can also protect an exchange-traded fund or an exchange-traded commodity, and other financial instruments as well. That's what put options were designed for, is protection of assets. Puts can be used for protection, or they can also be used to take advantage of a downward move of a particular stock or the market itself. So what can happen? Well, if you own a put or you own insurance on your house, what could happen is that nothing happens to the home or nothing happens to the asset, and the insurance can expire worthless. But if the house does burn down, or your stock or your index burns down, the insurance pays for that loss. Here's a risk graph of a put. Now this is a risk graph of a $50 put, and we could see we paid $5 for this $50 put. Now what's going to happen is as that asset drops in value, we can see that by the horizontal axis of this graph, as the asset drops in value, your put gains value because it gives you the ability to sell something at a higher price than what its current value is. So you can see that as the stock goes down or as the asset goes down in value, you're gaining more value. Another thing you'll see is that at the $45 mark, you break even at this particular point. The reason being is you have to compensate for the $5 that you initially put into the trade to start with. You have to recoup that $5, so you break even at $45. Beyond that point, you'll make dollar for dollar all the way down to zero because the stocks or assets cannot go below zero in that particular case. You'll also see that we have a limited amount of risk because we cannot lose more than what we originally paid for this particular put. Now, put options are sold in contracts just as the call options, and in the U.S. market, we have 100 shares in each one of the contracts, but if you're trading outside of the U.S. market, such as Australia or the UK, you'll notice that they have 1,000 shares per their contracts. And why is that important? Well, when you're paying for options, you're paying for each individual share, so the cost will be greatly different from one country to another for the entire contract. Let's look at an example, and let's look at real value of an option. And here's an example of a stock trading at $23, and let's look at what each one of these puts represents as far as a value, what the real value of each one of these puts is. So let's take a look at the answers here. Let's look at the real value of those options with the stock at $23. The 10 put would give you the right to sell stock at $10. But if the stock were trading at 23, why would you sell it at 10? So obviously that option has no real value. If you looked at the 15 put, you wouldn't want to sell the stock at 15 when you can already sell it in the open market at 23, so that option has no value. The 20 put also has no value because there's no reason you would sell stock for 20 when you could sell it for 23. But look at the 25 put. The 25 put gives you the right to sell stock at 25. With the stock at 23, now you have an advantage. That advantage is the real value of the option. In this case, $2 per share. You can sell stock at 25, everybody else can only sell it at 23. The 30 put gives you the right to sell stock at 30. Well, with the stock at 23, that 30 put gives you $7 of real value. So that's the real value of the options. Join us for more education here at nooptionantics.com. If you have questions, you can email us at info@nooptionantics.com. This is Peter Zamaya, thanking you very much and hope to see you soon.